zero DTEs perform when the VIX one day is super low like it is now. And I wanted to see if there was any kind of relationship between, is it even worth to trade the zero DTEs if the VIX one day is, let's say, less than 10 or less than 12? Because it's obvious to me that when the VIX is higher, there's obviously more juice, there's more things to do. When the one day VIX, when it's under 10, is there even enough money to be made on those days?
Just to make sure everybody's clear about what VIX 1D is, it's an indicator. You don't actually trade it. You don't buy or sell VIX 1D. It just looks at the one-day SPX options. It takes those options, runs them through the VIX algorithm to get its own one-day VIX number. It's an annualized volatility like every VIX is, but it uses only one day or zero DTE options in its calculation. So rather than the straight VIX, the VIX, which is 30 days out, this comes up with a synthetic 30-day expiration. This looks at those very, very short-term options. And right now, I think it's 8 and change. If you actually type in VIX 1D in the platform, you'll see a number. And I think last time I checked, it was under 9, I think. So that's what this piece is about.
VIX one day this morning, 8.39.
Yeah, okay.
8.39. All right. It's crazy.
So there we are.
My argument would be, without seeing this research piece, my argument would be that it is very difficult to do a one-day VIX trade with an 8.39 volatility, because if you don't take profits like immediately, 5, 10, 15, 20, 25%, that over the course of the day, there's just way too much risk for whatever the potential return is. There's nothing about that trade that I like. I didn't know if that's actually the case or not. So I asked the research team to look at it and to look at variations of the VIX one day to see. Like, I know the numbers will be better if the volatility is higher, but the question is, like, what do you do if you want to trade the 0 days and it's a day like today with the VIX is under 10? Do you sell the front month straddle? Do you go to wider strikes? Like, I mean, what do you do? I don't know.
And my own trading performance with the VIX this low reflects that it is harder to make money. I get surprised, I got to take profits, if I have them at all, much sooner before I get surprised in the afternoon. This is also a question, does the VIX one day, it being so low, capture the risk when you have a big rally or a big drop in the afternoon like we've seen? So let's see what they have.
Many new option traders know that the zero DT marketplace as fast, liquid, and profitable. That's because over the last year, not much has happened. Except we go higher, but volatility's been collapsing. And there hasn't been a lot of big drawdowns. So at Tasty, we often look at implied volatility to help us judge attractive opportunities for selling options. The VIX one day is calculated using the same procedure as the VIX, but using 0 DTE and 1 DTE option prices in place of the 30 DTE option prices. And recently, this number has been very low. Like I said this morning, it is 8.something, 8.40.
39.
Yeah, I haven't seen it there. That's kind of, I feel like that's an insane low number, but whatever. Has the level of the VIX one day served as a predictor of the performance of the 0 DT short premium positions? So we did a study and we used 52 weeks worth of data every 10 minutes, like we do every week for the 0 DT studies. We considered selling straddles, 10, 20, 30, and 40. We considered selling straddles and then 10, 20, $30 wide strangles. You can't go much wider than $30 because the expected move is only 20 right now. So anything outside of 20, there's going to be absolutely nothing there. Trades were closed if they reached 25% of max profit. Otherwise, held to the end of the day. We contrasted the performance on the VIX one-day level at the market open, and all the trades were assumed to exercise at mid-price, and the cost of the buying power reduction, controlling the long strikes, was ignored, meaning we didn't buy any wings. The results are a few dollars worse per day if you want to be realistic about this and you want to add wings, right? We didn't add wings for the purpose of the study, but if you want to, take a few dollars off per day. Okay, this is the VIX one day and the 0 DT performance. This is the VIX one day under 10. And we don't usually do the straddle. We usually go to the expected move. And the expected move right now is around $19, I think, per day. So that would put us at about 90% the win rate. That's obviously pretty good. The average P&L, though, over this time period was only $17, taking profits of 25% and letting your losers go all the way. So your worst loss, let's call it $1,100. Your average profit was about 17, including all the losses. I'm not so sure that's a great risk reward.
Well, it's what? It's less than 2%, right? It's like 1.5% or something like that. If you buy the wings, you're going to give up a pretty good chunk of that $17. Not a lot, but you're going to reduce that number. Yes, your CVAR is going to drop, and CVAR is your average actual risk. In other words, what's the actual expected loss that we've seen over the study? To give up any profits to reduce your risk, it's really hard to do. It's not an efficient use of capital. That's what this is telling me.
I was surprised that all the numbers were actually positive on the average P&L because I thought those numbers would be under 10. Now, we don't have a lot of history of VIX one day under 10. I also thought those numbers would be negative, and they're positive, so that's impressive.
It didn't surprise me that they're positive because, like I always say, the volatility, whatever it is, whether it's 8% in the 1 day, 12% on the 30 day, or whatever, is still the best predictor of what the S&Ps are going to do. It's not perfect, but it is still the best, and it's borne out with this. The question is not whether it's accurate or not, but whether you get rewarded for taking risk. And these numbers say, yes, you are rewarded. You're picking up not nickels, you're picking up pennies in front of steamrollers.
So this is how I divided these up. Under 10, 10 to 12, 12 to 15, 15 to 17, and then I think over 17. So we look here, now we're getting a little bit higher VIX. This is between 10 and 12 and a half. And what you see here, the numbers went up by, it doesn't feel like a lot of dollars, but the reality is they're about 50% higher as soon as the VIX goes just a couple of points higher. And that goes across the board from the straddle to the $10 out of the money strangle to the $20 out of the money strangle. Like the last slide was 17, this one's 26. The CVAR is basically the same. So you obviously have a little bit more money. I'm not saying that this makes a lot of sense either, but what it does do is it presents that all the cases over time are positive. That's the key. All the cases over time are positive. And again, the $20 out of the money strangle, which would be my default in most cases, because that's the expected move, it's a little bit more attractive when vol goes up a little bit. That's it. But you're still at the 89, 88% win rate. It didn't change at all. So now we get up to a little more aggressive, which is the 12.5 to 15, which by historical standards is very low still. The numbers go up just a little bit more. So you can see there's a definite trend that as the VIX one day goes up, the amount of money that the CVAR stays the same. The straddle win rate goes down. The strangle win rate at $20 out of the money goes down a little tiny bit, but the P&L goes up a little bit. Now we're double where we were with the VIX under 10. We're double that. I mean, with the VIX one day under 10, we're double it at 34. We go from 17 to 34.
And this is an important metric to look at. Now, you can see this behavior, either the straddle, the $10 strangle, $20 strangle, $30 strangle. You'll see this throughout. But what we're focusing in on, just to make this make sense in our Tom's and mine brain, that the $20 strangle goes from $17 when the VIX one day is below 10, $26 when it's between 10 and 12 and a half, and 34 when it's between 12 and a half and 15. So let's put that in context. The reward doubled. Okay, VIX under 10 versus VIX between 12 and a half and 15. The reward doubled while the VIX went up about, let's say, 60%. So the VIX doesn't have to double for your reward to double. That's the key. The VIX has to go up under 10, somewhere under 10, like 9-ish. Up 50% would put it up about 13, 13 to 14. That's what this 12.5 to 15 level is. But your reward on average went from $17 to $34. It doubled. That's the impact. It is a non-linear impact. That's why volatility is so important when you're selling premium. You get rewarded more than what the VIX, what you might think.
Because the VIX one day, this is 15 to 17. This is a little bit more, I guess you'd say this one would be a little bit more in line with getting back to like average one day VIX over time. In this case, you can see the going to the $20 out of the money, The number now basically almost doubles again. Just like TP was just explaining, these numbers, now your CVAR jumps up here, so you're taking more risk. Now you're taking more risk and you're being a little bit closer to being rewarded more fairly for it. I would argue here that you start to go out of the money. As volatility goes up, going out of the money makes more sense.
Yes. And this is a case where you can chop that CVAR number way back by buying wings.
Of course.
And when the VIX is over, let's say between 15, 17 and a half, now that $50 credit, $54, gives me a little bit to work with buying wings. Yes, I will pay a couple of dollars for the wings, a few dollars for the wings, because I'm still making some money for the risk I'm taking. When the VIX one day was under 10, I was giving up a huge percentage of that $17 to reduce my risk. It just didn't. I don't want to trade either one of those. I don't want to trade a short strangle naked, and I don't want to put an iron condor either when the VIX one day is under 10. That's the message I'm seeing from this data. When the VIX is more normal, when the VIX one day is up around that like 16, 17, then I can do the iron condors. Here's where it makes sense, because I still make a respectable amount of money on my profit, not $54, somewhere in the $40 range probably, but my CVAR will be much, much smaller.
And this, I believe, is the last one when the VIX one day is over 17 and a half. If you remember, so this means the VIX doubles from where it is today. VIX one day doubles from where it is today. We started this thing at the $20 out of the money strangle. The payout was $17. If the VIX one day is over 17 and a half, that number goes to 88.
It's 5 times bigger.
Yeah, I was going to say it's 5 times greater. The argument that higher VIX one day is better for this trade. Now, if you look at the straddle number, all along, that hasn't changed at all. The straddle number was 56 or $66 down at 8.5. So the straddles don't change. The takeaway from this, I hope I'm going to be right about this. The takeaway is going to be, if you're doing out of the money, it's up to 5 times greater when the VIX one day is higher. If you're doing 0 DT trades, the VIX one day is really low, do the straddle, because you're better off with the bigger options. It's the only way you can make any money. Volatility goes higher, you have to do the out of the money options, because that's where the payout's 5 times greater.
But the CVAR on the straddle is going up. So the credit you get, those at the money straddles, the SPX option traders know what they're doing. They know what the expected moves are. They know what the SPX can do in a day. Those straddle prices don't change much. But the CVAR, if I think back to where it was when the VIX one day was below 10, 10 to 12, that sort of thing, was much lower than 52.21. For the straddle, the reward is the same, but your risk is increasing with the VIX one day above 17. For the OTM, the $20 OTM, it's gone up a lot. The credit has gone up much more than the CVAR, your average risk. So that's why looking at this, I would be biased towards the out of the money strangle as opposed to the straddle when the VIX is over 17.
So over the past year, as long as you're willing to manage winners aggressively, shorting SPX 0 DT premium has been a generally winning approach. The VIX one day did provide an indication of how these positions performed. Higher VIX one day had a slightly negative impact on win rates, but a positive impact on P&L, especially for further out of the money options. As TP and I pointed out, the $20 out of the money strangle went from a $17 win rate to 88, which is 5 times greater, as the VIX one day went from under 10 to over 17 and a half. So that's a tremendous difference. A 0 DT trader who adjusted their strike selection according to the VIX one day would have seen the best results in lower volatility, being willing to trade closer to the money, meaning the straddle was better in lower vol and the strangle was better in higher vol.
And this is why we have transformed the way the industry talks about the markets, trading, and risk. Over the year, our focus on this information and our explanation of what it is and putting it into actual trading context, everybody else has copied us and adopted this approach. 10 years ago, 20 years ago, nobody was talking about this stuff. Nobody even knew what the VIX was. Now it's everywhere.